and today I want to talk about real estate investing, specifically in Southwestern Ontario, how it's changed and evolved over the last couple of years. It's much different than it was when I got started in this journey in 2012, my first property in 2012, to where we are today. So I want to dive into that a little bit today, and I want to explain why I think you should probably sell. If you own property in Southwestern Ontario, you should probably sell it as a result of this conversation. I've talked to several people now who, as a result of this conversation, have come out and said, wow, maybe I should sell. And apologies for the echo, by the way, because we have no books in the bookshelf. We're all packed up, and we're getting ready to move soon. So it's a bit more of an echo in here, and I don't have anything to stop the sound chamber. So it is what it is. Before I get into that, I also want to talk about the stock market, and I'll give you updates on that throughout today. So remind me on what's been up there. Overall, I've been coming back to break even, which has been great. But my crypto investments have, or any of my plays that are tied to crypto, of course, today with the 25-30% correction we saw in one day, that obviously wasn't good for my crypto holdings. But overall, not that far down, considering on the year to date. So since January this year, I'm up over $500,000 still. Now I am down $500,000 in my options portfolio, but I was up 350. So I'm only net 150 down. I just lost 300 that I had made since March in gains. So I'm not really down. I'm actually overall up almost $500,000. I wanted to be clear on that. Last video, I had a lot of people message me and be like, Mike, I can't believe you lost all this money. It's like, well, I didn't lose money. It's just the last 30 to 60 days, I've had a huge pullback. And that's, again, mostly a function of the market. And again, I want to talk about my investing strategy. You guys know I run the options wheel. I build a diversified dividend cash flowing portfolio, but I never claim that I can beat the market long term. I know over a 10-year period, I won't be able to beat the market. I can't put the time in. I am not special. And if you believe you are special, you're wrong. No one's special. Even Warren Buffett in the last 10 years hasn't really been outperforming, right? So it's very, very difficult to outperform the index. Almost no one does. So just expect to do as good as the index, which is cool. Like that's almost a 10% return. It's like 8% compounded annual growth rate, right? And if you use a little bit of leverage, then it can be, much, much higher, right? Especially if you only use that leverage in dip days. And if you back test that with, fire sim calculations, you'll figure that out. But anyway, back to real estate. That was supposed to be the topic for today's video. I have a little notebook here. I might scribble some notes. I might need someone in the comments to pull out their calculator for me because I'm going to make this example up just to prove my point. Okay, so people think they have a lot of cash flow, and myself included, I built a real estate portfolio on cash flow. But at these valuations today, in the last 12 months, we've seen 45% appreciation in my local market in London, Ontario, Windsor, a whole bunch of areas in Southwestern Ontario. We've seen, I like that. Someone just put a comment in there. It says, the best investment is time in the market. Put out fishing rods in every pond. Don't focus on picking one pond and just fishing there. Throw your fishing rod out into real estate. Do a little bit of lending. Put it into public equities. Buy a business or invest in a business. Spread it out. Maybe buy a little bit of cryptocurrency too. And some gold, silver, and commodities. A little bit of everything. Put it all over. Don't put all your eggs in one basket. The nice thing is time in the market will rise all ships. And so if you're sailing or you're fishing in those ponds, you're going to win as long as you're spread out. If you're not all in crypto, don't do that, right? You're not all in real estate. Again, don't do that, especially right now where valuations are right now. I'm not feeling extremely bullish. And I'll talk about why the government is actually, initially, I had thought that the inflation stuff would drive real estate prices up, but I can see scenarios where this inflation, quantitative easing situation the government's creating will actually crush landlords and be a reason why I don't want to invest in real estate and why I might be selling at least half of my real estate portfolio this year, potentially even 3/4 of it. I'll never sell everything. I'll always keep a little bit. You know me, I'm about diversity. And so I like to have my assets spread out, but I would like to be a lot lighter in real estate. I would like to see maybe less than 1/4 of my net worth into that in the long term. That's where I kind of see myself shifting. And you guys know I was like 95% real estate, super heavy, right? Even 2 years ago. So I'm going to talk with an example about how if I came to you right now in London, Ontario, for people who know this market, and if I came to you with a property and I said I got a property for $400,000 that brings in $3,000 a month in rent, it's a duplex, you'd be like, oh my God, sign me up. Can I buy this? And it's turnkey. Like all I have to do is just buy it. There's no huge renovation. There's no evil tenants. No. This is like a turnkey good deal in a decent area. That would be like fly off the shelves in this market. Probably 450 easily, right? I got a property like that I'm going to walk you through. Most people I would talk to would look at that property and say, hey, I bought the property. And in this case, I actually bought the property for under 170,000. It was a great deal. But over the last couple of years, it's appreciated. Now it's worth, say, 450. You would think at the surface, oh, Mike's got a great cash flow, he bought it so cheap. No. You got to run your numbers on current market value if you refinance the capital 80% loan to value. That's a mandatory. If you don't do that, you're actually devaluing your own capital. You're giving yourself a terrible return on equity. So let's pretend that you refinance the property. The choice is either refinance and keep or sell. If you can't refinance the property, you own it in cash, you own it, compared to market value, your mortgage is half. Sell immediately. That decision is so easy. The return on equity is terrible. There's no argument you can make to me, mathematically speaking, to hold a rental property that you have paid off more than 60% loan to value. So if your mortgage is currently less than 60% or less than the current market value, by the way, in the last year, if you haven't refinanced your property, you're way below that because all the appreciation we've seen has made it such that at current market values, your loan to value is not going to be near where it needs to be. So either it's active and you're refinancing every year all your properties, which again is a job in and of itself, or you have to make the decision, do I reallocate this capital somewhere else and get a better return on that? And we're going to talk about that in a second. But let's talk about cash flow, because a lot of people will come to me and say, Mike, I'm looking at this property, and I hear people look at properties that are $600,000-700,000 and they rent for $3,000 a month. A duplex that's got $1,400 from a nice 2-bedroom unit, and a 3-4-bedroom unit that's rented for like $1,500-1,600, something like that, $1,700 maybe. That's like $3,000 a month. That's a very common, $500,000-600,000 in London will get you a property. If it's nice and turnkey and doesn't need any work, that's what it'll get you, right? And so that property, let's peel back the onion on that, because I see so many Instagram posts of people bragging about their cash flow in their real estate portfolio, and I know they're lying because I have a bunch of properties in London, Ontario, and I know exactly what the numbers look like because I've done this 75 times. I can tell you exactly what the real cash flow is, whether they're tricking themselves and not factoring things in like vacancy, bad debt expense, maintenance expenses, capex expense, or management expense. That's the only way they're getting to cash flow, right? But let's walk through a real example, $3,000 a month. So $3,000 a month in this property. My property taxes are $250 a month on this property. So I'm gonna make a note for $250. Let's start at the top. $3,000 a month in rents coming in on a $450,000 property. And you get $250 a month in property taxes right away off the hop. You've also got management fees, which are typically 8%. 8% on $3,000 is $240. I'll put $250 down for easy math is your property management fee. Assuming that they're really good at maintaining the property, as in like they don't mark things up when you have a plumbing issue. They don't call Salis Plumbing at like $300 for a service call. Hopefully they're calling a nice plumber at the handyman. It's like $40 an hour. That's ideal, or $30 an hour. Then they can keep the cost down for you. But most property managers won't. I'm going to be middle of the road. I'm not going to put down a bad property manager that's going to make it negative cash flow. I'm not going to put down the best property manager ever, which is probably yourself, where you can really scrimp and be super frugal and keep your costs super low. I'm going to go middle of the road and say the average investor. We got taxes, right? We've got management fee of $250 off the top. So on our $3,000 rent, we're right down to $2,500. Now we've got utilities. This is off the average of all of my student rentals, my Airbnbs, everything. Now this might be a little bit higher because again, I have higher occupancy with a student rental, or sometimes the tenants are a little bit more liberal when it's all inclusive. But I'm going to assume that it's all inclusive in this situation with a cap on utilities. So that's typically how I run things. On a property that's about $450,000 like this, bring in $3,000 a month in rent, I'm going to use actuals. So my hydro is about $250. My gas is about $95. My internet is about $75. I supply internet because in this case, I just picked a student rental. It has higher cash flow than a normal property. So a normal single family would cash flow worse. I'm trying to make the cash flow look better. So when you can see that it's negative, you're like, holy crap. If student rentals even that are like a lot of work and energy, and they're high cash flow, if they're not cash flow positive, then for sure my single family is not going to be. So I got $250 for hydro. I got $95 for gas. The hydro includes the water, by the way, and that's a pretty conservative bill. I see it creep up even into the 300s on some months, especially in the winter. $75 for internet, $30 for reliance, and that will be about the utility totals there for this example. So we've got rough math on that. We're looking at $350, $425, so $460 approximately for utilities per month. It's going to come out of your account there. And then you've got things like insurance, which is probably about $110 a month if you're adequately covered. You got an average kind of policy, you got $100 a month. I'll round down in this case just to make it more cash flow, right? And I like that. I want to just shatter the myth that people are living off of their real estate portfolio cash flow. They're not. They might be living off the mortgage paydown and refinancing that back out, but again, that's not an ideal situation. That's real estate in London, Ontario. In Toronto, nothing. KW, Kitchener-Waterloo, nope. Ottawa, nope. All the major, any city you actually want to live in that has a lot of people in it, not going to have these cash flow numbers. We're going to walk through a real example right now. We're in the middle of it. If you're just tuning in, welcome. So $3,000 a month in top line rent on this $450,000 property. You get $250 a month in taxes, $250 a month in property management. I consider real estate to be a passive investment for me. If I'm actively managing, that's a job. I have to detach. Even if I'm managing it myself, I want to pay myself something for doing that. I have to separate the act of management from the real estate investment. If you want to make it actually passive and look at it as a business, you got to factor in your time too, right? And in my personal opinion, unless you're worth less than $30 an hour, you should not be self-managing your rental properties. You're giving yourself a terrible pay. The best property managers make like $40 an hour. That's the cap, like maybe 50 if you're lucky, if you're a good tenant placer maybe. But like property management's not high value, so I think you should outsource that. I've been a proponent of outsourcing. Once you have a reasonable sized portfolio, if you value your time, you should outsource your property management, make it truly passive. It's not truly passive because you got to manage the manager still, and you got to handle the bookkeeping, the financials, I'm sure, behind the scenes, and you got to assist the manager. So there's still going to be some management there, but it's somewhat passive compared to stock investing. Not even close. Like I invest way more time into real estate portfolio management than I would in a stock portfolio than if I built a passive stock portfolio. So you can't really compare the two. I think real estate is much more active than the stock portfolio. You should get a better return for that, was the point I'm trying to make here. If you're getting the same return as the S&P 500, which by the way got 25% last year, then I think there's gonna be problems there, right? And cash flow wise, again, it's very hard to beat what you can get building a nice dividend portfolio levered up. I think that 10, 12% return that you can do in lending or with the dividend portfolio levered, it actually is starting to crush what you can do in real estate if you eliminate the appreciation piece. Because again, I don't know if it's going to go up, down, sideways. We've had insane appreciation levels in the last few years, and over the long term, real estate should do 5% a year. So we're way ahead of where we should be on our appreciation curve. So there will be a correction at some point. It may be flat for a period. There may be no pullback at all. It might just be flat for 5 years. In the late 80s, early 90s, real estate, if you bought a house in 1990 in Toronto, in 2000, the house was worth the same amount. You held it for 10 years. Imagine buying a house right now in 2021, and in 2031, it's worth the exact same amount as it is today. That's a reality. We've been through those types of cycles before in the real estate space. I can't predict the future. I don't have a crystal ball. I'm going to talk about some of the bearish factors in the real estate space in a second here, but I want to get through this example. So for those just tuning in, we're walking through an example of how there's no real cash flow in even the best cash flowing deals in London, Ontario. And it's worse in other markets where rents aren't as high, like Windsor has much lower rents. However, the cap rate's a little bit better. So similar to what you'll find in Windsor, similar to what you'll find in, well, probably better in London than you'll find in KW and Toronto area, Ottawa, et cetera, so forth in Ontario. So where was I? I was talking about insurance. It was $100 a month. I had the utilities written down here. Next, we have maintenance expense. And I typically like to go with if it's a student rental, I go 10% of rent is maintenance, because once a year the student's going to move out, you got to repaint, you got to fix stuff up. That costs thousands of dollars. So I typically will do just 200 in this case, and that's assuming between a 5 and 7% maintenance expense. If you're outsourcing, $200 a month leaves you the odd plumbing call here or there. It leaves you enough to do a unit turnover, et cetera, and so forth. So it's $200 a month you have to allocate for your maintenance. If a lot of investors won't do 200 for maintenance, and they won't do 200 for capex. And capex is like when a furnace goes, when a roof goes, windows, things that you have to do on the property that are one time every few years. Something goes and you got to spend like $5,000 on a new furnace, or $10,000 on a new roof, or the windows are broken and you got to do, or not broken, but like they don't work properly anymore. Time to upgrade those. Those are like long-term things you have to do to the property. I like to allocate again between 5 and 8% of rent to that as well. So we've got maintenance at 200. We've got capex at 200. We've got bad debt expense at $75 a month. Once in a while, a tenant will skip out on rent and you'll be short a little bit. And here in Ontario, there's almost no recourse to go after a tenant that doesn't pay. And in most cases, you can't even get it. It's not even worth your time. So I allocate $75 a month to what's called bad debt expense. Once a year, once every couple of years, you'll have a tenant skip out, you'll lose a month's rent. It sucks really bad when that happens in that month because you're huge negative cash flow on that month when that happens. So that's why I like to allocate a little bit, 50 to 75 bucks on a property of this size every single month, just so it's there for when that event happens. You're good, you're covered if that tenant doesn't pay for 1 month. Now I've had situations, I had a tenant once that was a professional scam artist. When we finally got the sheriff eviction, 11 months after they moved in, they hadn't paid a single dollar in rent other than their first and last. And they ended up dragging it out for 13 months just before COVID actually got them out. Luckily, because COVID would have made it a 2-year eviction. And these people literally, they to my face were like, we are never gonna pay. This is what we do. We've been evicted for the last 10 years. We get to live for free for a year. We're professionals at this. It was disgusting actually that they got away on due process from the first eviction and actually they got out of it for, it's just crazy. Anyway, that's an example of like an extreme case where we had no cash flow for a whole year. We were negative on a whole year on the property. That stuff happens. I'm assuming that doesn't happen. I'm assuming you have good property managers, which I didn't. I had a bad property manager, placed a bad tenant. That shit happens. That's life, right? So that's part of real estate investing. $75 a month, if you're gonna balk at that number of bad debt expense of 75 bucks, get in the field and outsource your property management for a few years and see. Pick the best property managers in town. You'll still have these issues. I'm still chasing some of the best property managers in town, tenants they replaced by them, and tenant skipped out on last month's rent or whatever. This stuff happens. So I get 75 bucks for bad debt expense. And then another thing that happens too is during unit turnovers, a tenant will leave on the first when they move into their new place, and they'll leave the place full of junk. And you got to clear it out. So you can never rent it out again on the first unless you have a really good tenant. So once in a while, you're gonna have it, especially on a triplex or something with multiple units. One of your units is gonna turn over and there's not gonna be a tenant lined up. So you're gonna have a vacancy period, what's called vacancy allocation expense. If you have good property management, they can turn it around quick within the month. And hopefully once it's nice, they can show it and rent it and have it rented for the next month on the first. If you have a slow month or a property manager that's over capacity and they can't get everything done, or you're trying to ask too much rent or whatever, or it's a C-class property, you might be 2-3 months, right? You might have a month of rehab, then a month of showings, and then it's placed. I have a couple property managers in London who took 3 months to rent out a place, and they said that was industry standard. I talked to a couple other property managers in town. They said, yeah, that's normal. You got to renovate for a month. When the tenant moved out, then we got to do pictures and showings. It was a long weekend, so we didn't get it posted till after the long weekend. Okay, we're doing showings. No quality, high caliber tenant wants to move in 2 weeks from when you're showing it. They want to move in a month and a half to give their landlord notice. So you find that good quality tenant, and then you're waiting 2 months potentially for them to move in a worst case scenario. So I'm going to be super middle of the road on this. It could be a lot worse. There are a lot of outsourced property management, rental property situations where, and I'm going through this if you're watching right now, we're actually walking through an example about how I guarantee you if you own a property in London, Ontario, you have no cash flow. If you do, it's because you're working in it and you're trading time for money, or you're tricking yourself into believing numbers that are not actually, they're not the real situation. They're not what's actually happening in the landscape. So $75 bad debt expense, I'm gonna do $300 a month for vacancy. That's 10% of rent. I like that number because once a year, once every 2 years, a tenant will move out, and I assume a couple of months, a month to turn it over, and then you're waiting for a new tenant to move in on the first of the, if it's midway through the month, you gotta wait for the first of the month to then rent it out, right? So typically what we're looking at is once every 2 years, a tenant will turn over, and you'll have a month and a half, 2 months of vacancy because the turnover, and then putting the tenant in. If you're lucky, you might not have that, but it does happen occasionally over a 5-10 year period. It will happen on your property. So you should allocate so that when the time comes, you have that there. I'm probably missing some expenses here. I'm just trying to quickly think. The mortgage, I think, on this property specifically, we refinanced it, and I think the mortgage is about $1,600 a month. Now, that might not be the best rate ever because it was a rental property, but it's in that range, I believe. So on $3,000 a month in rent, if I told you I'd get $3,000 a month on a nice, clean duplex for 450 grand in London, Ontario, in a good area, turnkey, you jump at that. Like any realtor in town, I call them, they would jump at that deal, right, to buy that. They think there's cash flow. And the investors I see I'm posting on social media, et cetera, so forth, think there's cash flow. I even thought there was cash flow because I bought it for 170, right? So I'm like, oh wow, I bought it so cheap. Of course there's cash flow. No. My return on equity adjusted with refinance produces no cash flow at market value. Look at market value. What is the property worth today if you refinance it today? On my invested capital, let's say I'm 80% loan to value on a $450,000 property, you've got, with closing costs, 90 grand of your own money tied up. You have $90,000 of your own money, and we're gonna walk how this is negative cash flow on your 90 grand return. You're getting maybe some appreciation, and then maybe some, well, for sure you're getting some mortgage pay down. So let's run through a calculator. Does anyone have a calculator to add this up for me real quick? I don't have it here and I just don't want to tire my brain out. So if someone can jump in the comments and say, hey, I've got a calculator, I'm going to run off these numbers and we're going to get to the actual brass tax cash flow. So someone hopefully has a calculator on their computer, or they can add this up for us. But we got 3,000 in rent at the top line, 250 in tax, so minus 250, minus 250 again is 500, minus 460 for utilities. We're already down to almost 2,000 in the rent that's left. Another $100 in insurance, minus another 200 in maintenance expenses, 200 in capex expenses, 75 in bad debt, 300 a month in vacancy allowance, and then 1,600 a month in mortgage payments. Someone run that real quick and tell me what the net is on that. I can pretty much tell you it's a negative a few $100, but I need someone to do the exact math. Someone shoot it out there for me. I'll repeat it again while someone does the calculation here. So you have 3,000 in top line, you've got 250 in property taxes, 250 in property management expenses, which is again super low. When you place a tenant, by the way, you're gonna pay a tenant placement fee. Typically it's 1 month's rent. So if you're replacing your tenants every year, that's potentially another $3,000 in management fees, right? So you're down a couple of $100 here on a rental property. That's, by the way, a screaming deal in London, Ontario. This is a cash flow deal. Most realtors would be like, wow, the advertising how great this property is because it has so much potential cash flow. There are people I know buying duplexes that make $2,000 a month in rent, and they're even worse on their cash flow numbers than this, right? So you're negative $200 a month. You have to put in, someone just did the math for me, negative 435. Like, someone's negative 300, someone's minus 185, someone's minus 435. I think it's in the range of worst case scenario was around $500 a month. Best case scenario around 200, 250 was kind of what I was seeing too, depending on how you played with the high-low sensitivity data on the expenses. But yeah, I just gave you a great example of a screaming property in London, Ontario, where you got to put in $200 a month. Now, a bad situation happens, you get a tenant that trashes the place or whatever, you might put 3, 4, 5,000 in. I know people are talking about financial freedom, talking about real estate being a vehicle to financial freedom, and it is. The buying of real estate under market value and transforming it, the flip or the BRRRR, there's a huge amount of money to be made there. But the hold afterwards, that's where people are going wrong right now. It doesn't make sense to hold. The ROI is negative from a cash flow perspective. With mortgage pay down, you might be positive $200-300 a month. You don't get that. That's being tossed away into an account, right? So it's just, I look at this and I'm like, wow, why do I still have 20 properties? Why have I not sold off more? Part of it for me is FOMO, fear of missing out on further appreciation. The other piece for me, the major driving factor more than FOMO, is actually the amount of work it would take to get the properties vacant, to get them ready, to clean them up, to get max dollar and to put them on the market and sell them. That takes a lot of energy. I would spend a year full time just disposing of my real estate portfolio. And I have no interest in going through that struggle. So instead, I sell one off every few months. You've been watching my channel. You know that I've been selling a property off for the last 18 months. I've been selling one off every other month. So that's just been my strategy. I've been slowly divesting the worst properties first. The properties that didn't fit my investing ethos, I've been throwing those away first. I have been acquiring the odd deal too. Like if something comes up that makes sense, I buy it. Now after holding it for a couple of years, I'll probably dispose of that too, because the buy and hold math doesn't support. When I can sell my sixplex at a 4 cap rate in London, Ontario, 4 cap rate means guaranteed negative cash flow. That's what 4 cap means when you factor in management, vacancy, bad debt expense, maintenance, capex, insurance, et cetera, so forth, everything, right? Like a lot of the cap rates don't accurately cover all of the expenses associated with investing in real estate. So after doing this, I challenge you to run this accurately on all of your properties. And what you'll find is that between 25 and 50% of rent just goes to property management, tenant placement, vacancy, maintenance, capex, et cetera, and so forth, right? That's where most of the rent is going. Very little is ending up in our actual pockets. It feels like we're negative, right? Someone just asked, if it's negative, why would someone buy your properties? Why would someone buy any property in Toronto, London, Ottawa, Windsor, KW, Kitchener-Waterloo, any of those places? There isn't a property that's cash flow positive if you outsource management. If you self-manage, now you're tricking yourself into believing that there's cash flow because you're actively working in it. That's a job. I separate the job piece, the active working on your property, and the time investment from the actual investment itself, right? It just doesn't make a lot of sense, right? And so basically the cap rate you need to really have positive cash flows between 10 and 12. And there's very few places where there's strong economic fundamentals and those cap rates. Now it exists, but I think, yeah, someone just popped up in South USA. There are places where there's 10 and 14 and 15 and 16 caps. I'll be driven down there. I'll be cashing out here, and I'll be investing in places like Florida or Texas or red states where I can pass on inflation. Now let me talk about another reason why I really don't like real estate. The quantitative easing and the government printing is resulting in something that is a bit scary, inflation. And how does inflation play out? Well, our core tenant base, their living expenses go up, and they're on fixed income for the most part, so they have less money to pay for rents. So rents actually don't go down while inflation's going up. Landlords can't pass on inflation to their renters. Here in Ontario, there's a rent freeze right now. Even if you're lucky, once COVID's done, they might allow us to increase it by 1.8% again, like they used to allow, right? So hydro was gone up 15%. Let's talk about, all the utilities have gone way up. Gas has gone way up. Lumber, construction, maintenance costs. I call a plumber now, it's $60, used to be 30. Labor costs have gone way up. Property taxes are way up. The value of houses has been driven way, way up because of interest rates being very low, right? The cost of debt has gone down. That's forced real estate prices up. Eventually, the government is going to have to react to inflation. They can't let it run rampant. The only lever that they really have is two things, basically, to just pay for the quantitative easing. One, capital gains tax on all this money they've created in real estate. That's coming. Biden's already started doing something in the US. We are more socialist here in Canada. That is coming. Right now, capital gains tax at the max marginal bracket is 25% in Canada. Half of capital gains are tax-free, half of them you pay at your top marginal bracket. It results in an effective tax rate of 25% here in Canada. That's great for real estate investing. It's the same for stocks. It's a fantastic way to earn income, to invest and be taxed at a preferential rate. They've already tabled it. There's already been discussion. The CRA's put that out there. The Fed's already talking about here in Canada, talking about getting rid of that 50% tax-free inclusion. So I think in the future, people talk about afraid of selling now because of taxes. We're gonna pay 25% tax. In the future, it's gonna be 50% tax, not 25% on capital gains. We're already talking in the 40% range in the US. Canada's coming to 50%. It's gonna be here in 5 years, mark my words. That's what they're gonna pay for all this quantitative easing. So they're coming after the asset classes that have appreciated the most. Which, again, they manufacture appreciation in real estate. They've created this 45% appreciation. It's almost entirely government created through quantitative easing, through stimulus they've handed to businesses and to individuals, and then they lowered interest rates to stimulate the economy. They created this real estate boom, and now they get to tax it. It's perfect. Inflation is the best thing they can ever have. And it's the worst thing for the landlord because the result is higher interest rates in the long term, which crush cash flows because our property taxes go up, our values on our properties go up, so our costs go up, eventually the interest rates come back up and crush us, and we're in a rent-controlled province where I can't pass that on to anyone. So I just have to eat it, and I'm already negative cash flow. Just wait for the reckoning that's to come when we see commodity prices like gas going up 10, 20% to heat these properties, 30% in some situations. We've got, imposed new taxes as well on top of that. It's not a good climate going forward here in Ontario, but there are great places to invest in the red states in the US where, again, they're very Republican, and Republicans they tend to be pro-low tax, pro-business, pro-passing on you can, in some states, pass on rent increases of 20% in a year. And that's legal. Here in Ontario, you can't do that at all. Rent's frozen. And on California, rent's frozen. Like, those are terrible markets to invest in real estate from a cash flow investing perspective. Now, you could maybe argue that there's an appreciation play here, and that this, in the short term, this transient inflation that we're going through could result in short-term real estate price appreciation. And that's true. It has. And it is. But long term, this plays out, this hyperinflation I hear people talking about on social media and how it's a boon to real estate investing. Long term, this doesn't play out well for real estate. Short term, it does. Long term, it does not. It leads to a really bad recession and no cash flow for real estate investors. So just beware, guys. I think actually selling now is the prudent decision. We are way up. Like, all of us real estate investors, everyone who I know who started in this with me back in 2012, 2013, I remember the meetups in 2015, 2016, even if they had 4, 5, 6 properties, everyone's a millionaire. Like, everyone who invested in real estate, who just worked hard, put their fishing lines in, got a few properties, worked hard, invested that, reinvested it, they're all doing very, very well today. Take some of that off the table. Reinvest it somewhere else. Something in an inflation-adjusted hedge. Like, even an example, like a company like Facebook, as an example, a fantastic company. Whether we're in a recession or not, you have our eyeball space. In fact, in recessions, they get more eyeballs. And they can pass on inflation costs through advertising directly to the advertisers. Just pass it on, no problem. That's a business that'll do well through a recession. There's lots of businesses that can pass on inflation costs and it won't hurt them at all. That's a business where I'd like to reallocate my capital to that would do really well in one of these types of recessions that's coming as a result. There is a situation where potentially we just raise interest rates a little bit. Maybe they go back to where they were last year. February last year, I was getting mortgages at 3.24 5-year fixed, and I was happy about that. I was like, sweet, I got a 3% mortgage. Now 1.5%, and I'm like, ew, 1.5%, right? Because of COVID, they've dropped rates in half, but it will float back to 2020 rates. Like that's not, the government can sustain those interest payments. I know people coming out there on YouTube saying, hey, government can't afford to let interest rates rise too high. They won't let it happen. They have to let it happen at least a little bit. And when it does, coupled with the new stress testing rules here in Ontario, June 1st, it's now 20% harder to qualify for a mortgage. You qualify for 20% less. If they raise interest rates, it could be 30 or 40% less qualifying. That's a problem. If you can't qualify for, you can qualify for 30% less mortgage, guess how much you're gonna offer on that rental property? Less. It's gonna have effects. I'm seeing it in the market right now. We're seeing a slowdown. I don't know if it'll be flat. I don't know if it'll pick back up. I don't have a crystal ball. Anyone who claims that they do is a liar. No one knows what the future holds. It's all a crapshoot. We can have educated guesses, but the secret to becoming wealthy is staying true to the path. Don't pull out of your investment plan. Go ahead and do some options trading, build a stock portfolio, do some lending, own a couple of properties, spread it around a little bit everywhere, and you'll do just fine. Over the long term, you'll build serious wealth. Don't spend more than you earn. Tighten the spending, right? Start saving and investing. You'll do really well. Time in the market. Well, we're trying to time the market, right? So someone just jumped in here and said, did you buy the dip today? I did buy a little bit of the dip today. I did buy some of the dip today. It was I did acquire a little bit of Bitcoin, a little bit of Ethereum, by proxy actually. So I bought companies that are actively investing in that space for ease because I had a trading account already open and I didn't have any available funds to wire into my Coinbase or whatever. So I didn't do anything on those platforms, but yeah, for sure. I'm buying the dips, where I can. And I think that long term, it's hard to want to hold, sorry, I'm just looking back at my paper here. It's hard to want to hold real estate when, we're in a situation where there's negative cash flow and the environment is high risk. High risk, negative cash flow, that's a different environment than when I started investing in real estate. That's a different environment than 3 years ago when I was making videos talking to you guys about how great real estate investing was. We're in a different environment now. It's like, if I did an analyst report on Tesla 5 years ago, that's totally different than an analyst report now. You can't rely on that old data when there's new, stuff at play. Does that mean that I don't still like real estate? No, I love real estate. I'm still actively buying. I'm just not actively holding. We just acquired 3 properties in Sarnia, right? Like, I'm all about the buy. I can still buy smart, under market value, make a ton of money. I've made most of my money on the buy and the turnaround, the lift, right? Getting rid of bad tenants, solving problems on the property, doing renovations on the properties, whatever. There's always a play to add value. You're taking over problems and you solve those problems and you make money. With property management, you get paid very little to solve really annoying problems. So the buy and hold piece of the business is just not attractive. It was more attractive when I was buying at 10 and 12 cap rates in Ontario. In London, Ontario, it was the 10th biggest city, I think, in Canada at the time. Great overall fundamentals for manufacturing, education, healthcare, tech. The biggest university and the biggest college in all of Canada here in London, Ontario. I felt really good about a lot of the talent we had here, about the long-term fundamentals. And I was right in the long term. London caught up. It's blown up. It's 150% more for a house than it was when I started investing in 2011, 2012, right? But I'm now seeing, and again, I don't know how high things could go. Look at Vancouver, right? Vancouver's been unaffordable for a decade now, right? And continues to become more and more unaffordable, driven partly by foreign investment and a number of other things. So that could happen here too. I don't know where the top is. To claim that I know the top of this bubble or this growth curve that we're on. And again, I don't think it's a bubble per se. I think it's just we're ahead of our time on the growth curve. I think we've appreciated more than we deserve. And so I don't think there'll be a correct, because real estate prices are really sticky. People just don't sell for huge losses. They just hold. And so what ends up happening is we just end up going through like no appreciation at all for like a number of years. And how interesting is it to park 100 grand in a rental property where there may be no appreciation for 5, 6, 7, 8 years, and you're just making negative cash flow every month and some small mortgage pay down? I'd rather take that 100 grand and do private lending with it. I'd rather take that 100 grand and put it into a better vehicle that would generate more cash flow and a better overall return, especially if you can use leverage, right? I think dollar for dollar, real estate still kicks ass from a leverage perspective. I love that you can buy real estate 20% down. That's huge. You can go 5-to-1 when you first acquire the property. In a flat market where there's reasonable cap rates, I'm all about real estate. Real estate will always be a part of my journey. I love real estate. I just don't love these valuations. I just don't love the current risk environment around the Residential Tenancy Act with the Landlord Tenant Board right now, where there's just no power for the landlord. There's a power struggle going on, and I don't want to be on the wrong side. When the 51% are broke and can vote to steal from you as the 49% that's in the top half, it's a scary environment to be in. I've considered even leaving Canada and going to Florida or going to Puerto Rico or Costa Rica. I don't know where, but I like Florida because it's so easy. The culture's the same, right? At the same time, I love something like Costa Rica where there's a culture shock, where I can introduce my family into a new way of living and learn a new language, and it's a slower pace of life. And so I've thought about leaving Canada altogether. I could see a situation where there isn't, where the 51% or the 55% will vote to behead the top 10% and take everything they have. That's a scary environment to be in. I think we should reward those people who are driving the economy and employing everyone. That type of socialist, communist behavior leads to economic slowdown, leads to technological slowdown. The most advanced economies in the world were driven by capitalism. That's how you drive technological innovation. Communism doesn't work. No one wants to work. So the whole society doesn't advance medically or technologically as far as they could have. You need to incentivize people to do things. You can't just say, hey, you're all the same. If you sit at home and do nothing, or you grind your ass off for the betterment of society, you get the same. That just doesn't work. That's not how we progress. Humans need conflict. We need change. We need, self-actualization. We need a focus to push on. And so I think that, it's not let's go to the Q&A. I'm just gonna go to the Q&A now. Got 76 people on, by the way. If you're on right now and you haven't smashed that like button, you owe it, for the 79 people watching right now, you owe it to me to smash that like button. I'm trying to drop some truth bombs for you guys here to hopefully save you some money. You might say, hey, Mike, thanks so much for allowing me to get out of this. And again, every time I've sold real estate in 2015, 2016, 2017, I've taken that capital. And yes, I missed out on the appreciation I could have had on that property because I sold it, but I always put it into something else that made me more money. So that's where I think it's a big piece, is what do you do with that capital once you sell that property? That's the biggest piece. I see a plethora of opportunities all around me. So for me, the opportunity cost of holding my real estate portfolio is very expensive. If you have nowhere to put the capital, you need to make a plan first of where you're going to put that capital. If you got a rental property that's cash flow negative after you've just looked at the numbers, you're like, definitely, Mike's right. I need to be selling this rental property off. Well, guess what? I think you need to look and say, okay, now what do I do with that? Okay, Mike's right. Now what do I do with that capital? Do I explore something like low risk options trading, where you're buying stuff way out of the money on stocks you want to own anyway? Do you build a dividend portfolio using a little bit of leverage where you can get consistent dividends of 10% a year? Do you do, a lending portfolio, or do you look at buying a private business? Maybe you do buy another business as opposed to real estate, because real estate as a business isn't in, I don't think the factors are lining up right now in Ontario. Now, there are other places, again, where I think if you're watching this and you're in like Florida, in some town where there's like 14 cap rate, obviously look at local economic conditions, because I don't know why there's a 14 cap rate. There could be a reason. It could be because your town's like drying up and it's got terrible long-term fundamentals. But if it doesn't, take a look and say, wow, okay, maybe now that I can build a business around this. It's actually profitable, right? Let's go to the Q&A here, because there's been a lot of really good comments, and you've been watching and waiting for me to get to your question. Now I'm going to do it. Hey, how you doing? Hey guys, thank you for all the positive comments. That's right. Best investment is time in the market. Real estate is not going to be the place to be in Canada's communist future. I like Dylan's comment there. I think that's, I don't know if we're going to be full communist. I think we're more of a socialist nation, but I do see a shift left. I do see more and more of the have-nots ruling over the haves. And I think this equalization will be terrible for the long-term viability of the Canadian economy. It will push the jobs out. It will push industry out. It'll push people like me, smart, creative, ambitious people that are driving this economy, that are carrying it on their back. It's going to push us out. Because at a certain point, you can put a little bit of weight on someone's back. Like, you want to tax me 40%? I'll pay my 40% tax. I'll keep carrying it. When you throw 80% tax on my back breaks. I'm done. There's only so far you can push basically the top 1% in Canada pay something like 70% of all the tax. Think about that. Like, if you make less than $30,000 a year, you take more from Canada than you give. Fact. You take more from the medical system, the roads, the housing, everything. Like, you're a taker, and that's okay. But when there's too many takers in an economy, in a country, it leads to revolution, right? It's a problem, right? And so what we need is a better, well, there's a lot of things we know. I won't get into the politics of it. There are some viable solutions where Canada could turn and become a fantastic country still. We're not gone too far, and I'm not leaving Canada yet. I'm waiting and seeing, and I continue to try to contribute to the economy. I pay more than my fair share. I probably support 20, 30 families in Canada a year just on my own economic productions and the tax alone that I pay right across my companies and myself. Especially in the next coming 10 years, I'll probably support hundreds of families in Canada, and that's okay. I'm okay with that to an extent, right? There needs to still be an incentive for me to want to push, for me to want to grow the economy, to make things better here in Canada. Someone's got to clean up all the mess, right? Like, and there's got to be an incentive to do that. So, by the way, thank you so much for everyone tuning in. We got a great audience tonight, a lot of great questions. So someone jumped in and said they have a pre-approval for 1.75 30-year fixed. That sounds like a US thing maybe. Principal home with the wife, values are high, but other factors. So I want to talk about this for a second when we talk about real estate investing. I'm looking at real estate as an investment, not in a home. So I think that in Canada, you should own your home. There is huge value in owning a primary residence. It is the single best tax vehicle in Canada. Your primary residence allows you to shelter all your income, no tax. If you buy a house for 100 grand, sell it for 500 grand, 10 years from now, all that completely capital gains tax free. I don't think Trudeau and the federal government will touch that for a long time. They would have a huge lashback from Canadians. They'll tax the capital gains on all rental properties because, again, most people only own one rental property or don't own rental properties at all. Most people own their house and that's it, right? So the majority will still vote for taking from the rich, right? But if you go for the primary residence, you're going to get slaughtered politically. So that won't happen for a while, I don't think. I think we'll definitely see a capital gains tax increase from 25 to say 40 or 45%, well before we'll see them attack the primary residence. Also, the place where you live can be an amazing house hack. If you own it, you can customize it. You can put another unit in. You can rent it out and you can live for free. So house hacking is an amazing, amazing vehicle to building financial independence. I think that's, even at current valuations, it makes sense. Buy a duplex like I just gave you an example of, live there and have your mortgage, at least your expenses paid for. You can self-manage because you live there. It's not so much work. When you're living in the property, it's a lot less stress, a lot less risk, a lot less damage. You can pick a better tenant. And again, I think that makes sense. Buying your primary residence makes sense. Don't sell that right now. I think don't sell your house and go and rent. I don't think that's a prudent decision. We're not going to see a huge correction in Canada. We'll see a flatlining, I think, more likely. The primary residence is an amazing thing. So I talked about selling your rental properties. If you have rental properties, that makes sense to sell. The numbers don't support. But your primary residence, I think there can be arguments for the primary residence to be held as opposed to being sold right now. So yeah, hopefully that helps a little bit on your question. Next question was, it's funny how some people try to retire on a few properties based on their calculated cash flow. It's a pet peeve of mine. I see it all the time on new YouTube channels, on Instagram, on Facebook, in the local real estate investing communities. I see someone get 3-4 properties and they're like, I'm retired, I quit my job, it's all good. Like I'm, the rental king, cash flow king. And I'm like, you have 5 properties. And I know in the areas where those properties are at market value, you have no cash flow. You have mortgage pay down and appreciation. Like, don't lie to people, right? Don't lie to yourself. Worst of all, don't quit your job. Like, you're not there yet. Unless you got a plan to, some entrepreneurial venture where you're flipping or wholesaling. Okay, if you're gonna invest your active time, cool, I respect that. Don't say you're retired because you're actively investing. You're an entrepreneur, and that's okay. But yeah, I mean, it's been a pet peeve of mine. I think it tricks investors into getting into things that they shouldn't be getting into. Real estate is high stress, high effort, high energy, a lot of labor input. for a decent return. Like you can make a lot of money in the flipping and the wholesaling. In the holding, it's a lot of energy too, just less return. And so where I'm looking at like a 5, 6, 7% return holding real estate, I'm like, ew, that's not attractive to me. I would much, much prefer a way better return on my capital elsewhere. And that's because I have so many other opportunities. Maybe that's why I see real estate as unattractive now. Maybe it's because I was conditioned to look at real estate deals 2, 3 years ago where it was amazing. We were getting great cash flow. It's just not the same today. Next one. Hey guys, thanks for the comments, all the positivity. I appreciate all these comments. Even though I'm not responding to them, I'm reading them right now and you guys are awesome. Do you do private lending? Can you talk to me about how you structure that through registered accounts, or should I do unsecured? So I think we could do a whole video just on talking about lending, you know, unsecured versus secured, unsecured being promissory notes, secured being on a first or second mortgage, secured on title of a property. I like to go the secured route. It's my favorite way to do it. If you're gonna lend unsecured, make damn sure you're getting personal guarantees from really wealthy people with great reputations, with a lot to lose, with deep roots in the local community, as well as look for, another thing I look for is a good social media presence. I wanna be able to watch them like a hawk. I wanna know that they're not gonna be a flight risk. I wanna know what's going on in their world. I think it's important, again, if you're doing the lending piece and you're doing, like a lot of people are raising money to buy apartment buildings or raising money to buy rental properties. And I think you gotta be careful, especially these people who are newer or who don't have really large net worths or don't have a lot to lose. There's a lot of risk with the unsecured piece. Secured, again, a lot of risk there too, potentially. It's about who you're lending to more than what you're lending on, in my opinion. I think it's about the person you're lending to, especially if depends if it's a non-recourse or recourse mortgage. In the US, non-recourse mortgages are very common. Non-recourse mortgage means you can take the keys, if the property goes down in value, and throw them at the bank and say, I'm done, and they can't even go after you. They take the property and that's it. Here in Canada, recourse mortgages are very common, where if you walk away and give the keys back to the bank's gonna come into your house and take your shirt off your back. You've agreed in your mortgage to give them everything, including your firstborn. So in the US, people just walked away, they had a housing crisis. Here in Canada, we can't walk away. They'll come in and take our car, they'll impound everything until they're made whole. So it's a different climate. Real estate won't crash in the same way it did in the US, mainly because of recourse and non-recourse mortgage structures. That's just a nature of the US economy versus the Canadian economy. That's just a random fact I'm just throwing out there to make you feel more comfortable with investing, I think, in real estate here, and partly why I believe the real estate market won't crash per se. It'll just go slightly negative or a bit of a flat for many years. People just don't need to sell, so they don't. That's a big piece of it. Here in Canada, we have a really low default rate. One of the reasons is that. Okay, next question was, the last part of that question, sorry, was about Olympia Trust. So Olympia Trust, there's a bunch of different trust companies you can use to lend money out of your RRSP and TFSA. You can 100% do it. It is totally legal here in Ontario, in Canada as well. You can take funds in an RRSP, tax sheltered, and a TFSA, tax sheltered, lend them out and get great returns. You can do some cool things called the MELT strategy. Been talking about on this channel for 3 years now. I think 3 years ago I did a video on the RRSP to TFSA MELT. So you can check that video out if you can go find it in my archives somewhere. It exists out there. But it is definitely, I was one of the first to talk about it in the whole community. I know now you see it on everyone's channel. Maybe Kiva even did a video on it recently, had someone on talking about it. I was like the first to break news on this before it was even like a guideline on whether this was legal or not. But you basically would take a large sum of money in either your RRSP or your unregistered like open account, lend it out in a mortgage and a first mortgage, and then put a second mortgage on from your TFSA, do an effective rate of say 9% on the mortgage, but pay 2% on the first mortgage and like 25% on the second mortgage. So you funnel all of those interest payments on that mortgage into your tax-free savings account. So you could potentially grow your TFSA at a 25%, it goes up to legally 29.9%, about 29% annual compounded growth rate. That's insane. You can turn a TFSA from the current limit's like 80,000, approximately 75,000, I think it is, from 75,000 to 750,000 in like a decade using this method. And the government can't touch it, it's tax-free, it's legal. That's a cool piece in the lending vehicle if you can find an arm's length person to invest in with this strategy. That's huge, right? Like no one can touch that. That using your TFSA for that is the best, the highest and possible best use for your tax-free savings account in Canada is private lending through TFSA. There's nothing better with a dual strategy where you're legally funneling most of the, and it only works if you can lend 2 mortgages at once on the same property. So you split your funds, some into your TFSA, and then some not in the TFSA. And that way you can funnel all the high interest stuff to the second mortgage, which again, a second mortgage can have really high interest rates. It's doable. So yeah, something to kind of ruminate on if you're trying to tax plan. I definitely think the TFSA is a powerful vehicle that's underutilized here in Canada. Most people don't even know it's more than a savings account. People think it's a savings account. The TFSA tax-free savings account is not a savings account at all. It's an investment account where you can shelter income you make inside of that account. That's the best, in my opinion. I think there's, again, when it becomes when there's a big contribution limit inside your TFSA over time, all growth inside your TFSA increases the room in it forever. Same as losses also decrease the room in it forever. But if you can have a good history of investing in your TFSA for a number of years, you will build up a huge nest egg inside of it that is completely tax-free from the government. That's huge, in my opinion. Okay, now I'm going back over here. Invest in different markets in the Midwest where there are multifamilies that still cash flow. This is true. That is definitely an option. I would sell properties here and acquire in a better market where there's better cash flow and better regulatory environments to support the business, the rental business, that there aren't here. It just doesn't make sense. I think eventually there'll be state-owned property, or I don't know how it's going to play out here, but I can't see private landlords wanting to own things. I could see, maybe a foreign Chinese investor wanting to come in and just park cash and get a 3% return. Cool. They might be a good landlord because they're happy with a really low threshold of return. I'm not that happy with that threshold of return when I see the other opportunities that exist in this space. And yeah, it's hard to pass up good opportunities, right? By the way, if you're watching this right now, you can share this with some people. We're at 89 for a second. We're at 85 right now. It'd be cool to get 100 people on the live stream all at once. So pass this to some friends. We're at 86. We're 14 people away. Just share this to some friends. Get some people to pop on. It'd be cool to get the stream to 100. That would be a little, pat on the back, letting me know that you guys like this content again. It's been a bit since we talked about real estate investing and more of the overarching economic fundamentals on it. So I thought it was time for at least a bi-monthly update on where I thought things were at. So someone said, hi Mike, quick question. Hey William, good to see you on again. So he says, let's say you have a put and the stock crashes, you sell the put and you make money. 1 week later, the price is up 20%. How do you determine if you should buy the put again and when? So William, a lot of that comes down to, again, your internal valuation system on how you're going to value the stock and where you think the price is, relative, the book value relative to current market price. You could have a price in mind that you are willing to pay for the shares. And if there's a 20%, growth in the stock price, there's usually a reason. So find out what that reason is. Maybe their earnings are up, and so therefore your valuation on the company should change and it should be more valuable. Maybe it's just market noise, in which case the stock might be overvalued. It might be time just to wait. In which case I might sell a put way out of the money. Let's say the shares were, I'll give you an example. Let's say a company's at $100 a share and you bought puts at 90, you made your money at 90. The shares went to 120 a share. I might then go sell puts at 90 still, because I still want to buy in at 90. And maybe the premium I'm getting is very little for that, at that price, that strike price in that contract. But I'm staying true to my value system. I'm like, this is the price I'm willing to own it at. And probably you want to sell those puts on a down day so you can get more premium for that price, right? But yeah, again, it depends on what valuation you're comfortable with. If you think there's the reason for the price increase is justified, then invest in it. Don't trade on technical analysis. I don't like trading on TA, on technical analysis, because no one knows the future. You can't look at candlesticks and know for sure whether Bitcoin will be $100,000 in a year. You just can't. Trends can shift like the wind with a tweet, with a new news article, with anything, right? So I don't like to trade on anything other than fundamentals. I can't pretend to know the future. You can't either. If you claim you can see the future, you claim you're an oracle, you're lying. No one beats the market consistently for 25 years. No one has a crystal ball. So I don't believe in trading in that way. I like to trade on positions that I want to hold. And I actively trade on it for a tax advantage and for the fun of it, to be honest. So I have certain prices I'm okay owning the shares at, and I'll often, have my shares called away for premium, and I'll often get back into the company again on down days. But it's positions in my portfolio that I want to hold. I'm just playing around with them. I know I can't beat the market, but using leverage, I can enjoy the market and do it in a tax efficient way and a fun way. So yeah, you can also manage risk a little bit better, I think, with an options portfolio. You can reduce your cost base a bit, and there's something to that. But yeah, again, most option traders don't outperform the market, so don't expect to. even flips are hard right now because labor is hard to find and materials are up all the time. This is true, Sonny. It's very hard to flip right now. It's very expensive to flip right now. The good flippers are still flipping and making money, but yeah, it's tough. That's why I'm conflicted on investing. Numbers don't make sense. Yeah, I mean, it's a challenge. Sometimes on the buy, it can make sense if you're buying under market value. There are those opportunities that pop up. Do you trade options on Bitcoin? No, I don't trade options on Bitcoin. I do trade options on companies that have large positions in Bitcoin or Ethereum, or that mine it, or that somebody involved in the chip production, et cetera, and so forth. So I'm investing in the space and behind the technology, and I like Bitcoin and Ethereum, but I'm not actively buying a lot of it right now. On the next dip, I might. We had a big dip today. I thought about it. We'll see. I'm waiting to see, because I do think Bitcoin will be at 100,000, 3 to 5 years from now. Ethereum, I think, is gonna, for a time period, almost eclipse Bitcoin in market cap. There are some other altcoins that I really like too, but again, super high risk stuff, right? Like, who knows if it drops 80% in the next year? We could have a down cycle that pushes things way down. There is no real floor. It's use cases and what people are like, user adoption, which can change with the wind, right? A better crypto comes along that's faster, whatever, and all of a sudden, Dogecoin is the next, Bitcoin. Who knows, right? Like, if they work with developers to make the technology better, you're investing in tech and you're investing in people, and people can change and tech can change, right? They're very high risk fields to be in, but it is the future. And so I think in general, I like the whole tech. I gotta put my daughter to bed here, so I gotta wrap this up. I will pick 3 questions. If I missed your question on here, do I still have mentees? No, I have just Jonas, who's a friend now. I don't really have mentees. I thought about the new place. I've got a 2-bedroom, like 1,300 square foot, 2-story guest, house unit, and I thought that might be something that I would bring a new mentee on, like someone with a couple or something maybe. I don't know. I've thought about it, but it's a lot of time investment to bring on a mentee, and it needs to be a lifelong commitment. And I find that there's a lot that, for it to be worthwhile for me, there need to be a lot they would have to give to, right? And so it's finding the right fit is very, very hard. And my time is so precious these days that I don't want to give it away cheaply or give it away to the wrong causes. Low-hanging fruit, totally. Brandon says, Mike, refinance to the point where you have positive cash flow and lock in a 10-year term. No, I think that you refinance to the maximum that you can on the property, and if it doesn't cash flow at that point, sell the property. If you can't refinance your property all the way and still be cash flow positive, you have no business being in that property, unless it's your primary residence. Period. Unless it's a short-term play or development play, okay, maybe there's a lift you're trying to get. But if you're already maximized the property out, no, not at all. Get out of the property. Makes no sense. If it can't cash flow, fully levered, what are you doing? If you can't borrow your down payment and lever up 80% loan to value and have positive cash flow, you're not in the right investment. There are properties that will do that will cash flow positive. Invest in those. Don't invest in ones that don't. Reallocate your portfolio, right? Like, I think people don't do that. They don't treat their real estate portfolios like a portfolio. They don't analyze each individual position and dispose of some that are overvalued. You should do that. You should take a portfolio management theory to your real estate portfolio. Take the analyst approach to real estate. That's a smart and prudent way to do it. There are other factors too, emotionally, I'm sure, that, if you have a pain in the ass tenant, that could weigh in heavily too. And that's okay. You're allowed to let emotion and effort and all that come into the decision process. Yeah, I like some of these comments here about capitalism, and I wish I could go into the deep hole on that, but I gotta put my daughter to bed here pretty soon. It's a no-brainer for you to make courses on investing, easy money, and a fun project for you. Chuck, I probably should. I can make some courses that had real value. I could write some books that would have real value, that would be like, I tell shit how it is, how I see it. And again, I've pivoted so many times based on new information. If someone comes to me and is like, hey, these are like 6 facts you didn't consider, I'm like, shit, I didn't consider that. Good point. That one point, good point. Other 3 points, I can refute those, whatever. But one of them could change my perspective. That's what I like about, finding someone that you can listen to that's not biased by their own personal drive to raise capital or their own personal drive to sell you deals or whatever, right? Like, realtors always trying to sell you something. All the gurus out there are trying to sell you courses and stuff. So I wish there was something like, I think a book's better because you don't take much from the person. It's like $20 for a book, right? That's nothing. It's a rounding error for most people. And you get a lot of value from a book. So I think the free videos I do too are something that's huge. Once in a while I get a super chat, but it generates income in the same way that like a book would. It's hard to really make good income from doing YouTube. But I try to deliver a ton of real value. Like the value in this session we just had of this hour is probably more than some people deliver in coaching calls and full courses that I've seen. I've seen some courses people sell. I peeked under the covers and I'm like, this is not $2,000 in value. So there's a lot of that going on where people are giving things away at prices that don't make sense. Thanks, Ken. I appreciate that. It's a positive comment. Thank you, Robin. You're familiar with Questrade's margin power. I don't like Questrade. I used to be at Questrade. I still have an account there, but it has no money in it, or very little money in it. I'm all in at Interactive Brokers, IBKR. If you don't have Interactive Brokers account, you need one. You can borrow on margin, which means you can have a line of credit basically you can use to buy stocks, 3.34 to 1, or you can build a stock portfolio and draw out 70% loan to value, like a line of credit mortgage. You can use to buy real estate, whatever you want to do, at 1% interest. Prime minus 1.5. Questrade is 6%. It is 600% cheaper to borrow at Interactive Brokers than it is at Questrade. That makes all the difference. On a dividend stock that's generating a 5% yield, if you can borrow at 1%, 3 to 1, that means you get a 15-20% spread. At Questrade, you're costed at 6%. If your stock's yielding 5 on a 3 to 1 yield, you're losing 8%. The difference is like, I don't even want to borrow on margin at Questrade, but at Interactive Brokers, you're a fool not to. Park it in a REIT or something super stable, like an interest-bearing bond, and you make more. So it's just crazy how cheap the debt is at Interactive Brokers. And the platform's not bad. The trading fees are pretty good if you're an active trader. The platform's easy to use in your phone, super, super easy to use. I have a link for it in my last 2 videos. Maybe I'll post one here if I remember, where you can go and download Interactive Brokers and use my referral code. I get some free shares in Interactive Brokers. You get some. It's a couple $100 or $100 each. Cool. I love Interactive Brokers. I think even if I wasn't getting a referral code, even if you don't even use my link, whatever, you should probably use it. We can both make some money. But if you don't want to use it, whatever, still go to Interactive Brokers. Like, bar none, it's the best trading platform in Canada. Period. Might even be the best in the US. I don't know. I haven't studied the market there, but it is the best in Canada by far. Close down your TD Waterhouse account. Get into Interactive Brokers. Close down your Questrade. Get into Interactive Brokers. Much better platform. Way better leverage. Just overall a way better, cheaper platform that'll make you tens of thousands of dollars over a 10-year period. That's big money. In my case, hundreds of thousands of dollars in difference by being Interactive Brokers. So I can't flog how good of a company that they are, and I don't know how they make any money, just on the trading fees, I guess, and the market data. But I'll pick one more question. I really gotta tuck my daughter in, but you guys have been so engaged tonight that I don't want to leave, and I've been so engaged tonight. So I'll pick one last question. Opinion on Elon Musk's decision with Bitcoin. I don't know. That guy's all over the map. To answer your question, he's all over the map. He gains credibility, loses credibility. He has so much influence. He's almost like a pump and dump kind of guy. I don't know. I don't really care what he tweets or texts. I think that he brought a lot of notoriety and market share to Bitcoin by some of his tweets. And now, again, at the same time, he's trying to, it sounds like almost like the SEC was like, hey, you need to make a post. I feel like there might be something else going on there behind some of his actions. I don't know. But for sure, I mean, sustainability with cryptocurrency is huge. We need more solar, wind, renewable energy powering our grids, our power grids. And I think mining is a fantastic return on capital for investors. It gets people like me into the space. I don't know. I can see a lot of people moving to proof of stake. There's pros and cons to proof of work and proof of stake. Proof of work is the mining and verifying the transactions through like graphics cards and rigs. And then there's the proof of stake where you basically lock capital up to get a return and handle the verification of the transactions that way. Hi Mike, I recently bought my first house in Toronto. Builder lots, want to leverage equity for multiplex, but not sure where to look. What do you recommend? Definitely you should pull the equity out 100%. If you get the opportunity to do that, you should. As much as you can pull out as possible is ideal. You can then take that capital, and if you can borrow it at 1.5%, 1.7%, you can go take that and put it to work at 10% and make the spread on the difference, right? That's the idea. If you're gonna go borrow a second mortgage on it though at like 10%, that's scary. Stay away from high interest debt. That debt is bad when you borrow expensive debt that floats, that to buy bad assets. Good debt is super cheap debt that's self-servicing and cash flowing itself, and on top of that is tied to an appreciating asset and then used to buy further cash flowing assets that help service. That's good use of debt. That'll make you wealthy. All right, guys, I gotta go put my daughter to bed. Thank you all so much for watching. Someone jumped in there with question fees are high as well. It's true. Yeah, so you guys can do a bunch of Google searches yourself and find out all the great things about interactive brokers. It'll be all on their website about what companies are approved for maximum loan to value, et cetera, and so forth. Thank you so much, everyone, for watching. And if you're watching the replay tonight, smash the like button. Jump in the comments if you're watching this tomorrow, the next day, whatever, 2 weeks from now. Jump in the comments and just let me know what you enjoyed most about this stream. Say, hey, I loved it 53 minutes to 58 minutes. This part right here. Call it out, because maybe someone goes through the comments and they see that. And they wouldn't have watched the video all the way through, but they click on that 53 minutes and they get something from it. So pass it back to the community. That's what this is all about. I'm just trying to give this away for free for you guys. If you got some value here, smash the like button. And I'll see you all in the comments and on Instagram at, thank you so much. Everyone's just, I appreciate all you guys just jumping in here and giving all the positive feedback. It really keeps me motivated to want to keep going and doing these streams every week. So thank you so much, everyone. And I'll see you next week, every Wednesday live for the last 3.5 years. I've never missed a Wednesday on vacation, nothing. Christmas, I've always gone on, holiday or not. So you know, every Wednesday, 7 to 8 p.m., just like the sun is going to rise tomorrow, I will be live. I'll see you next week. And on Instagram at Mike Rosehart. Bye, everyone. The secret to unlocking a wealthier you guys know it, 3 levers. The secret to unlocking a wealthier you is 3 levers within your control. Spend less, earn more, and maximize returns on the difference. Bye, everyone. See you next week. Oh, and by the way, I cut my own hair with scissors. Haven't been to a hairdresser in 3 years. Did pretty decent with a pair of scissors. See you guys.